Our topic today is now you need money against your house. Please stay with us because I'm going to go through some examples so for you to understand what to do and when. So you're in a situation where you need to tap into the equity of your home, but you already have a first mortgage on it. So you have a regular mortgage that you took a while ago. Let's even say you took it or refinanced it during the really low mortgage rate years. You remember after the pandemic how low they were, and a lot of people refinanced at some point. About 75% of US mortgages were under 4%. It was like at the end of 2021, maybe even beginning 2022. So a lot of people are actually still sitting on those low mortgage rates. Our topic, we'll come back to this in a second, but our topic today is now you need money against your house. Do you refinance and kind of say goodbye to that low rate? Or let's say it's an average rate, or do you get a second mortgage? And a second mortgage can come in the form of a HELOC or a HELON. By the way, the related videos about HELON and HELOC you will find in the description of this video, and also we'll post them to the end. So how do you decide what to do? What considerations you need to take? Basically, is it just the cost, or is it a long-term, is it just the immediate cost, or is it long-term kind of program of what might happen? For example, if you just want a HELOC because it's very convenient, you can take the money anytime you like and put it back, you might be faced, you will be faced definitely with a variable rate and with a higher rate, because those rates are tied to what's called prime rates. Again, my more descriptive video will explain in more details. And by the way, please stay with us because I'm going to go through some examples so for you to understand what to do and when. So some other considerations. To do a second mortgage is usually so you have a first one. Again, let's say you took it years ago. Now you have a lot of equity in the home and you want to tap in. So to get a second mortgage done, many times there are different formulas, and they're usually stricter than just getting what's called a cash out. As a definition, we're going to go quickly with this. Cash out basically means you're applying for a higher mortgage and you're closing your existing one and you cashing out the difference. That's why it's a cash out. For example, if you have $300,000 left on your mortgage and your property's value is $750,000 and you need, let's say, $100,000, you apply for $400,000. The bank will give you an approval. You pay off $300,000. You walk out with the difference, minus the closing costs. So that's what's called a cash out. And then at the end, you only have one bill. Okay, that's the cash out. The second mortgage, you keep that $300,000. You will not actually do anything with this, and you get a second one on top of this one. Now at the end of this process, you will still get the $100,000 that you want, but you will now have two bills. Not only two bills, but two mortgages with different terms. Just not a problem. It's just not for everyone. Okay. And so please stay around for the example. As I said, we're going to go and see what makes sense or not. So before we get to that to that example, there is some other considerations, like maybe your income situation changed. You see, when you bought a home on refinance, let's say in 2021, because the rates were so low, okay, it was easier to qualify. Obviously, 3% rate and 7% rate, they makes a difference in the payment and makes a difference in the salary. So maybe you don't qualify anymore. So please stay around. We're going to, in the second part of the video, we're going to talk about, after the example, we're going to talk about what other programs were devised in the industry where you do not need to show income documentation and still get to your goal. So on to the example. let's say right now you have a mortgage of 300,000, and the payment is $1,500 on it, okay, per month, and your home value is 900,000. So you definitely have enough equity to tap into, and your goal to get another $200,000. Okay, so option number one is to apply for 500,000 loan amount. With this 500,000, we're going to close 300, let's say with a new bank. Pay, let's just say this is bank A. We go to bank B. Okay, we tell the bank B, okay, give us 500,000. We're going to clear out bank A 300 and minus 300 from bank A, and you were going to walk out with 200,000. So this is a pretty straightforward process. And remember, the mortgage will now be 500,000, and with today's rates, that means about $3,000 a month. Okay, and I am using a 6% rate to do this. Okay, so option number two over here, okay, we keep the 300. Let me just write this down. We keep the first mortgage, of 300K, and we're adding let's say what's called a HELOC, home equity line of credit, okay, of 200,000. Now on this one, if you can see, the rate is going to be about 8% or so, and it's variable. It can go, let me write it a little bit larger. It will go up, may go up or down. The payment is calculated the following way. You take 200,000 by 8%, that is 16,000 a year, and you just divide by 12. So that's approximately $1,300. If you can see, you have 1,500 over here, and then you have the second bill of 1,300. Seems to be lower because it's 1,500 plus 1,300. The total here is 2,800. So it's definitely cheaper. But remember, on this $1,300, which is again approximate, it's a little bit more than $1,300, you're only paying interest to the bank. You are not paying principal. So mathematically, it's going to be about the same. You do have flexibility here. Because it's a home equity line of credit, you don't need to utilize 200,000 all the time. You can take it. It's like a credit card against the house. You can take it and pay it back. You will find other scenarios where, math works out differently. So obviously this was an example and we made some assumptions. Your particular situation might be different, so you can always contact us and say, look, this is what I want. This is where I want to be. What's better for me, and then we'll guide you as much as we can. Some people are very, very particular. They want security, they want stability, they want certainty. So they say, okay, we don't want to deal with variable interest rates. We don't want to deal, we're so busy, we don't want to deal with two bills to pay. Others are more open to this. But I think the main factor, the deciding factor, should be the economics. What would make more sense. Please share this video with your loved ones. Like it and comment. Please engage. I would love to know your opinion, and we'll see you soon again.